everybody wants to generate passive income. I mean, who doesn't want to make money while they sleep, right? One of the best ways to do that from an investing standpoint is to invest in dividend paying stocks. So in today's video, we're going to talk about what dividends are and how they can benefit you and your retirement portfolio. So first of all, what are dividends? Dividends are basically the profits that a company pays out to their shareholders. So just take Coca-Cola, for example. If they make $1 billion in profit, they have some options. One option is they can just stick it in the bank and sit on cash and use it as, capital, just like you would in your household. You can, if you make extra money, you can put it in the bank and save it. That's one option that a company would have when they make a profit. The second option is they can use it for growth. So they can build a new factory or do some research and development to create a new product or anything like that to spur new growth. So they can go spend it to create additional future profits. The third option is, and typically you see this with more mature companies, is they can pay that money out in the form of a dividend to their shareholders. So if a company makes a profit, they take a portion of that profit and they'll pay it out to their shareholders in the form of a dividend. You'll typically see this is with these mature, stable companies. So not only do dividends provide income, they've actually accounted for about 40% of the growth of the S&P 500 over the past 100 years or so. And so dividends are a really good option for those who are looking to generate passive income. Now, which types of stocks pay dividends? Typically, your smaller companies, growth companies, they're not going to pay a dividend. A lot of times these companies aren't even profitable, so they don't even have any profit to pay out to their shareholders. But when they do turn a profit, a lot of times these smaller growth companies are going to be reinvesting that back into their business for growth. So what you'll see is what are called blue chip stocks. Think Coca-Cola, Johnson & Johnson, just your staple American companies that have been around forever, very mature, and have a very predictable cash flow stream. Those are going to be the companies that you see primarily paying out dividends to their shareholders. And there's even a class of these companies that we call dividend aristocrats. These are companies that have increased their dividend payout for the past 25 years consecutively. So this is really kind of that upper echelon of dividend paying stocks. Other types of stocks that you'll see pay dividends are utility stocks and what are called REITs, or real estate investment trusts, which those are required to pay out at least 90% of their taxable income to their shareholders in the form of dividends. Now, when it comes to the taxation of dividends, there are a couple of ways that they can be taxed. The first are qualified dividends, and these are going to be taxed at the lower capital gains tax rate, which depending on your income can be either 0%, 15%, or 20%. And then you have non-qualified or ordinary dividends. These dividends are going to be taxed at your ordinary income tax rate. So if you're in a very high tax bracket, there's less tax advantage to ordinary dividends. Typically, qualified dividends are going to be from US-based companies, and there's a certain holding period requirement on them. Now, when a dividend is paid out to you as a shareholder, you've got a couple of options. You can take that income and realize it as income, put it in the bank, just like regular income. There's another option, though, that a lot of people opt for, which is a dividend reinvestment plan, or a DRIP. And basically what this does is, as opposed to taking the dividend as income, what you're going to automatically do is reinvest that dividend into additional shares of stock of the company. Typically, you're going to be investing at whatever the fair market price of the company's share price is at that moment in time. Sometimes there will be discounted value, but typically you're going to buy into the company at whatever it's trading at that time. So to illustrate, let's say you have 100 shares of ABC stock. They pay a $1 dividend per share, and therefore you're going to receive $100 in dividend income. If the stock is trading at $50 per share, then with that $100 of dividend income, you'll be able to buy 2 additional shares of stock in that company. and you'll therefore have 102 shares after that dividend payout takes place. Then when they pay out the next dividend, you'll receive, if they're still doing $1 per share in dividends, you'll receive $102 in dividends as opposed to 100 like you did the last go round. Now, the great thing about a DRIP program is that you're going to automatically be reinvesting your money, and that's going to help you benefit from what's called dollar cost averaging, which is investing a set amount of money over a set interval. It's very convenient. It doesn't take any action on your part once you're enrolled in that DRIP program. In that scenario that I just laid out, you had 100 shares, then after the dividend payout, you have 102 shares, and so forth, right? So imagine that over a 10-year period, you're going to substantially increase your holdings in that company over time. Now, when you're investing in these dividend-paying stocks, one of the more efficient ways to go about it is to do it within a tax-advantaged account like a traditional IRA or a Roth IRA. The benefit of that is that you're going to get either tax-deferred growth in the case of an IRA, or in the case of a Roth IRA, actual tax-free growth, which is going to help you really further compound those returns over time. And when you factor this into your overall retirement plan, you can figure out which of those types of accounts will actually benefit you more down the line, depending on what your tax situation is going to look like now and in the future. And getting back to what we talked about at the beginning of the video, the greatest thing about dividends is that it's a way of potentially producing passive income. People are always interested in real estate investing and doing rental properties and things like that. But really one of the simplest ways to produce passive income is just by buying shares of blue chip companies and reaping the dividends that they pay. Again, those dividend aristocrats, those companies that have increased their dividend payout over the past 25 years, you can kind of just invest in those stocks, set it, forget it, and reap the benefits of those dividends down the line. So dividends can really be a powerful tool whenever you're doing financial planning and retirement planning to help you provide additional income over and above what you have coming in from Social Security, pensions, or other sources of income that you might have. So if you have any questions, as always, please feel free to leave a comment or a question down in the comments section, and we'll try to respond to you there. If you'd like to talk with us about your retirement plan and how dividend-paying stocks might fit into your retirement planning strategy, you can schedule a call with us. We have a link in the description. Just click that below. And please like and subscribe to this video if you haven't already for more content just like this. So hope you enjoyed, and we'll talk to you next time.